Everyone tells California first-time homebuyers the exact same thing. Save for a down payment and then get pre-approved. But if that's the only advice you're taking, you're losing thousands of dollars before even getting the keys. In California, buying a home here isn't just expensive. The contract rules and the laws here are fundamentally different than anywhere else in the country. Right now, I'm seeing eager buyers make these 5 massive mistakes that are completely unique to the market. I'm talking about getting blindsided by unexpected tax bills after moving in, or even accidentally waiving your rights just to win a bidding war. These are not just minor roadblocks. In a market where the median home price is $800,000, this single mistake can easily cost you tens and thousands of dollars. In this video today, I'm going to be breaking down the 5 critical mistakes that first-time homebuyers in California are making right now. Also going to be breaking down how the escrow process works, the strategies that I use to protect my clients' hard-earned money. If we haven't met already, my name is Jasmine. I'm a realtor here in Southern California, and I would really appreciate if you guys subscribe, like, and follow me on all social medias at Sold by Jasmine Led. Let's dive in. Mistake number 1 is the supplemental property tax trap. Let's go ahead and start off with the mistake that causes the most panic after closing: ignoring California's supplemental property tax. When you buy a home in California, your base rate for property tax is usually 1% to 1.25% of the purchase price. But here's the trap: the county doesn't update their tax bill immediately. Let's say you buy a property that's $800,000 from a seller who bought that property 20 years ago for $200,000. The seller was paying taxes based on that $200,000 value. When you close escrow, your lender sets up an impound account based on that old tax rate. But a few months down the road, the county assessor catches up, reassesses your home at the new $800,000 price, and basically ends up sending you a bill for the difference. That is your supplemental tax bill. Many first-time homebuyers mistake this mistake from their lender and they just ignore it. Do not do that. It is a real bill. It is your responsibility, and if you don't plan for it, you could suddenly owe thousands of dollars out of pocket that you weren't expecting to have to spend. Always look at the new purchase price when estimating your monthly payment, not what the previous owner was paying. Mistake number 2, the 3-day escrow deposit clock. Mistake number 2 usually happens the second your offer gets accepted. It's the failing to understand the strict timeline behind your earnest money deposit, or your EMD. The EMD is basically the good faith deposit that you are putting down to show the seller that you are serious. It's usually 1 to 3% of the purchase price. In the California Residential Purchase Agreement, it clearly states that you have 3 days after your offer gets accepted to deposit that earnest money. Here is where the first-time homebuyers make the biggest mistake. They leave that money sitting in an online saving account, a brokerage account, or a mutual fund. And if you have to initiate a transfer from an online bank, it usually takes up to 3 to 5 business days. So if you miss that 3-day window, you're actually in breach of contract before your escrow even properly starts. The seller can issue you a notice to buyer to perform, and in a competitive market, they might just cancel your contract and move on with the backup offer. Before you start writing offers, make sure that your deposit cash is fully liquid and sitting in a traditional checking account ready to be wired. Mistake number 3, blindly waiving contingencies in a bidding war. Mistake number 3 is a big one, especially if you're looking in a competitive California area. In the California standard real estate contract, you have 3 big safety nets: the inspection contingency, the appraisal contingency, and the loan contingency. These give you the right to investigate the property, ensure it's worth what you agreed to pay, and secure your mortgage. And if something goes wrong, you can just walk away with your deposit. Because our inventory is often tight, buyers get desperate. They think if I waive all my contingencies, then the seller is gonna pick my offer. And honestly, they might. But you need to understand how California handles this. We use an active contingency removal system. This means that your contingencies don't actually expire on a certain date. You have to physically sign a document to remove them. If you waive your inspection contingencies up front, and you later find out that your house needs a $30,000 roof replacement, or it has foundation issues, you cannot back out without losing your entire earnest money deposit. There are strategic ways to shorten your contingency period to make your offer look strong without completely giving up your legal protection. Never waive them blindly. Mistake number 4 is that closing costs vary by county. Mistake number 4 is assuming that closing costs are the same everywhere. In California, local customs dictate who pays for what, and it changes completely depending on what county or city you're buying in. Closing costs include things like escrow fees, title insurance, and transfer taxes. In Southern California, places like Los Angeles or Orange County, it is customary for the seller to pay for the owner's title insurance and transfer tax, while the buyer and seller split escrow fees. But if you move up to Northern California, the customs flip. For example, Bay Area and Sacramento area, the buyer is paying for the title policy as well as the transfer tax. If you are buying a home that's $900,000, these fees can add up to several thousands of cash that you need to bring to the table. So always ask your agent what the customs are in the area that you're buying in, so that way you're not short on any cash when escrow asks for your final closing costs. Mistake number 5, shifting your financial profile during escrow. Fifth mistake is changing your financial profile while you are in escrow. Once your loan is conditionally approved, first-time homebuyers usually think that the hard part is over. They get excited and they start planning out their interior design. They go out and buy a new refrigerator, a new washer and dryer set, new furniture on credit, or worse, they decide it's time to buy a new car to put in their garage. Do not do this. Your lender will actually run a final credit check and a verification of your bank balances before they actually fund the loan, often just 24 to 48 hours before you close. If they see a new inquiry, a new monthly payment, or a sudden drop in your savings, it changes your debt to income ratio. And in California's highly priced market, many buyers qualify by slim margins. A new $100 monthly furniture payment can literally cause your loan to get denied right before closing. So once you're pre-approved, once you get your offer accepted, once you're in escrow, please do not put anything on credit. Do not go spend a bunch of money. Don't get any new payments. Buying your first home in California can feel so overwhelming. But if you have the right strategy, you can avoid all these mistakes that people are currently making. And also, if you have the right real estate agent guiding you through the process. If you found this video helpful, make sure to comment what mistake surprised you the most. And don't forget to check out my next video that I'm posting next Friday. Anyways, thank you guys so much for watching. Please don't forget to like and subscribe and follow me on social medias. And also share this video with a first-time homebuyer or someone who you know is about to buy their first home. Thank you guys. Bye.